Welcome, aspirants! Today, we are breaking down the RBI's latest master direction on repo transactions. This is a really important update, and trust me, we're going to cover everything you need to be completely exam ready.
All right, here's how we're going to break it down. We'll kick things off with the single biggest update you absolutely have to know. Then we'll get into the jargon, the key terms that examiners just love to test. After that, we'll look at who can participate and what they can trade, run through the actual rules of the game, and wrap it all up with a rapid-fire summary of all the key takeaways for your final revision.
So first things first, the big update. Look, if you only remember one new thing from the latest changes, please make it this. This is the absolute headline.
And here it is. The key phrase is municipal debt securities. Now, this is way more than just adding another item to a list. The central government has officially given these the green light for repo transactions. And that is a huge deal. So why does it matter? Well, it basically makes these bonds way more attractive to own. Banks and other institutions can now use them to borrow short-term cash really easily. This is all designed to create a much more active market for municipal bonds, which in the end makes it easier for our cities to raise money for things like roads, water, and other big infrastructure projects.
Okay, before we dive any deeper, let's make sure we've got a solid foundation. These are the core terms you've got to know, not just to understand how the repo market works, but to nail those exam questions. So, what exactly is a repo? Here's the most important thing to remember. It's not really a sale. It's much more like a collateralized short-term loan. You're basically pawning a security. You sell it today to get cash, but you sign a binding agreement to buy it back later at a slightly higher price. And that little difference in price, that's just the interest on the loan. Simple as that.
And this one trips people up all the time, but it's actually super simple. A repo and a reverse repo are just two sides of the very same coin. It's the exact same transaction. If I'm borrowing money by selling my securities, for me, it's a repo. For you, the person lending me the money by buying my securities, it's a reverse repo. It's all just about your point of view.
Think of the haircut as a safety cushion for the lender. It's a risk margin. So let's say I give you a bond that's worth 100 rupees as collateral. You're not going to lend me the full 100. Nope. You might lend me, say, 98. That 2 rupee difference, that's the haircut. It's your protection in case the value of my bond drops before I buy it back from you.
And this is a brilliant little mechanism that shows how the system protects itself. Delivery versus payment, or DVP, is the foundation of safe trading. It means the securities and the cash switch hands at the exact same moment. It completely eliminates that scary risk where, you might pay for a bond but never actually get it. You don't hand over your stuff until you see the money. It's that simple.
And finally, we've got the tri-party repo. This is just a regular repo transaction, but with a trusted middleman, the tri-party agent. This agent handles all the messy background stuff, like managing the collateral, making sure payments go through, and taking care of custody. It just adds this huge layer of efficiency and security, which makes the whole process a lot smoother, especially for the big players. Okay, so we've got the lingo down, our foundation is built. Now let's talk about the who and the what. Who exactly is allowed to play in this market, and what can they use as their chips? These next two slides, they're pure exam gold. This is the official list of who can play and what they can play with. You're going to want to pay close attention here because these are perfect for those direct, fact-based questions. So who gets to play? Well, it's a pretty wide group. First, you've got any regulated entity, so anyone watched by RBI, CB, IRDI, and so on. Then you have any listed corporate. There's also a special spot for unlisted companies, but only if they're using specific government-issued securities. And of course, the big all-India financial institutions, or AIFIs like NABARD and SIDBI, are in too.
Now for the what, the actual securities they can use. To help you remember this for the exam, there's a handy little mnemonic, GCMCD. Just think of the phrase, good corporations meet for commerce and deposit. So that's G for government securities, C for corporate bonds, M for our new addition, municipal debt securities, another C for commercial papers, and D for certificates of deposit. And don't forget, units of debt ETFs are also on the list.
Okay, let's get into the mechanics, the actual rules of the road that control how these repo deals work. These are the specific data points you'll want to have right at your fingertips.
First up, the tenor, which is just the duration of the deal. How long can they last? It's pretty flexible. A repo can be as short as one single day. We call that an overnight repo, and it can go all the way up to a maximum of 1 full year. So the range is 1 day to 1 year. Nice and simple. Now, this is where it gets really interesting, because the rules actually show us how the RBI thinks about risk. Take a look at the minimum haircuts. For listed corporate bonds and the new municipal debt securities, the minimum haircut is 2%. But for things that are more liquid and short-term, like commercial papers and certificates of deposit, it's a bit lower, at 1.5%. This difference tells you how the regulator sees their relative risk. Pretty neat, right?
When it comes to actually settling these deals, it is all about speed and safety. First, the timing. The initial exchange has to be quick, either the same day, which is T+0, or the next business day, T+1. Second, security. As we talked about, every single transaction must use that ultra-safe delivery versus payment system. And third, for government securities, there's an extra layer of protection. They have to be settled through an approved clearinghouse, like the Clearing Corporation of India, or CCIL.
All right, let's pull all of this together. This is your rapid-fire revision section. Think of it as your final checklist before walking into that exam hall. You might seriously want to screenshot these next few slides.
First up, the big picture concepts. The number one update, inclusion of municipal debt securities. A repo is a sale with a promise to buy back. A reverse repo is just the lender's side of that deal. The haircut is the lender's safety margin, and DVP ensures a safe, simultaneous exchange. Got it? Good.
Next, the who and the what. Participants, regulated entities, listed corporates, certain unlisted companies, and all India FIs. Securities, government securities, corporate bonds, municipal debt securities, CPs and CDs, and units of debt ETFs. You should be able to reel these off from memory.
And finally, the critical numbers. Tenor, minimum 1 day, maximum 1 year. Settlement, T+0 or T+1, and always DVP. Minimum haircuts, 2% for corporate and municipal bonds, 1.5% for CPs and CDs. And don't forget this key detail. Over-the-counter trades have to be reported within 15 minutes.
And to leave you with a final thought, especially for those analytical questions, think bigger. This isn't just some technical financial rule change. By making municipal bonds repo eligible, the RBI is making them far more liquid and attractive investments. So how might that directly help our cities raise money for things like new metro lines, better water supply, or smoother roads? It's a direct line from a financial regulation to the development of our country's infrastructure. That's all for this explainer. Good luck with your preparation.